Marginal and Absorption Costing. Definition. Marginal cost, variable cost of producing 1 unit of output. Absorption cost, total cost of producing 1 unit of output including fixed and variable costs. Marginal costing. A costing principle whereby variable costs are charged to cost units and the fixed cost attributable to the relevant period is written off in full against the contribution for that period. Variable costs are those which change as output changes. These are treated under marginal costing as costs of the product. Fixed costs are treated as costs of the period. Marginal costing. Marginal costing applies contribution concept. Contribution equal to sales minus marginal cost. Contribution is important for short-run decisions involving changes in volume of activity. As contribution per unit is constant at varying levels of activity, output and sales, it is used to calculate total contribution by multiplying contribution per unit with sales volume available for paying total fixed overheads of the company. Marginal costing. Finished goods and work in progress are valued at marginal, variable, cost. Fixed costs incurred are deducted from contribution in order to show net profit for the period. Absorption costing. Using absorption costing, all costs are absorbed into production and thus operating statements do not distinguish between fixed and variable costs. Absorption costing. Finished goods and work in progress are valued at full production cost. Variable costs plus fixed costs. Under or over absorbed overhead. Adjustment for under or over absorption of overheads in absorption costing income statements at the end of the period. The amount over absorbed would be deducted from total cost. The amount under absorbed would be added to total cost. Absorption and marginal costing on inventory valuation and difference in profit calculation. The difference between the profit figures calculated under absorption and marginal costing principles is caused by the treatment of fixed production overheads. In marginal costing, the full amount of fixed production overheads is written off in the period that it occurs. In absorption, part of the fixed production overheads is carried between accounting periods as part of inventory valuations. Inventory values using absorption costing are therefore greater than those calculated using marginal costing. Since inventory values are different, profits reported in the profit statement will also be different. When inventory levels increase, absorption costing reports a higher profit as compared to marginal costing. This is because fixed overheads held in closing inventory are carried forward, therefore reducing cost of sales, to the next accounting period instead of being written off in the current accounting period, unlike in marginal costing, treated as period cost and written off in full for that period. When inventory levels decrease, marginal costing reports a higher profit as compared to absorption costing. This is because in absorption costing, fixed overhead brought forward in opening inventory is released, thereby increasing cost of sales and reducing profits. When inventory levels are constant, both costing methods give the same profit. The difference in profit between the two costing methods can be calculated by the change in inventory levels multiplied by the overhead absorption rate, OAR. Thank you for watching.